Jeff, I know we don't have all day, but I was in Claude, it's like remarkable. And I was like, hey, I'm gonna speak with Jeff. And I was like, oh my God, what the hell am I going to talk about? What Jeff been talking about? And you know, it did me a great summary. But one of the things, and it's a staple for you. And I read and I was like, okay, tell me that. I asked myself to explain it to myself again in that manner that we can disseminate to everyone. And I struggle. So can you give me your high school teenage explanation for the dollar shortage and not the dollar debasement? Your favorite subject.
Everybody loves dollar debasement because it sounds like it should happen, right? You've got a profligate government that's out of control. And so you think, okay, historically speaking, at least what you're told is historically speaking, that ends up with bad currency and destroyed bonds. But that's not always the case, and it has been always the case. In this case, with the reserve currency being the eurodollar, which is a bank-centered system, that's really disconnected from the profligacy of the government. So the sicker Uncle Sam gets doesn't necessarily mean that it has any bearing on the currency. And so the currency is a strictly medium of exchange. Its value, quote unquote, is simply whether or not it's useful and usable, and whether or not there's enough of it floating around there that people can use it in the way that they need to. And the answer is, number one, unfortunately, the eurodollar remains as useful as ever. It's the only thing that, it's the only option that we have. And number two, there just isn't enough of it. So if there's not enough currency, and it's still incredibly useful, the value of the dollar has to go higher, just as a simple basic economic.
So on behalf of the millions of people tuning in, so why is it's not okay? I want to say it's not evident there is a shortage of dollars. Now, I'm really one that pushes back against liquidity and liquidity measures. I think it's largely made up. My 2 pennies worth is that liquidity is being generated when global stocks are appreciating, because collateral, as it goes higher, in many people's mind, is becoming safer. And if we work our way back into the euro-dollar world, markets with trending higher stock markets are typically markets where the banking counterparties are expanding the universe of collateral, and that's very pro-growth, if you will. So when I look at the world, I struggle with the dollar shortage at this moment in time.
Because you're looking at the stock market signal and saying that tells you something about liquidity.
And economies are, they are. I mean, the US is expanding, China's not collapsing, etc. It's not like,
because
it's not very evident. The renminbi is, what is it, 670, not 770,
But that's the other part of the Chinese signal. You look at the bond market, and the bond market tells you that liquidity is low and growth and inflation expectations are low, which are all part and parcel of the same thing. So
the Chinese bond market.
Absolutely. It's the brightest signal there. And what would the U.S. Treasury market look like if not for the Federal Reserve's interference at the front end of the yield curve? So I think you are right. Liquidity is not, it's one of those things that's very difficult to get your head around, because it's not a single concept, and liquidity changes by the freaking minute sometimes. But when you look around at some of the behaviors of marketplaces, you can see that there is shortfalls of dollars, whether it be disruptions and instability in currency markets, or, gold is a particularly relevant example in the last couple of months. We know that there's a dollar shortage based on just the Iran conflict and think about it. I just had a conversation with Keith Weiner of Monetary Metals, one of the companies that he deals with. They were, what does he say? They were long Qatari oil and short Brent futures heading into the conflict. Well, the Qatari oil is going to be worth something once the Strait of Hormuz opens up. But in between then and now, that company has a zero asset, or a piece of collateral that's worth zero. And their broker keeps calling them for more and more margin, which means they made more and more dollars. And the only way that they can meet that margin call is by selling gold, because it's another part of their portfolio. So we see, dollars or gold sales that are substantial enough that they knock off the price of gold. That's a signal that dollar liquidity isn't good in some way, shape, or form. So you look at the stock market and say, okay, that tells you something about the economy and liquidity. I don't look at the stock market. I look at the bond market and the credit markets, and they say the exact opposite. They say that liquidity is drying up. And if you take away the central bank interference in the front end of the curves look a lot different. They look a lot more like China or Switzerland's. Switzerland's curve almost back down to zero again. The 2 years almost to zero, the 10 years at 30 basis points. That's not a good world. And Switzerland is a barometer for, at the very least, Europe, if not the rest of the world too. So I don't think it's that difficult to make the dollar shortage case. It's doing it in a way that seems like it makes it matter to most people on the street.
Can I stop you there? I think, because I want to push back and say, I hear what you said, but it doesn't feel like a what do you call it, a slam dunk or whatever, so you cite like one bad hedge, right? In a world of zillions of operators and hedging, okay? And what we can say, so we have to pull the lens a little bit further out, yeah? And what we can say is, America came in and like hit Iran hard, okay? And how many $200 oil things that I read, and how many things that are going to happen saying you got to sell everything. And the stock market is inches away from a new all-time high. Oil prices, frankly, unconvincing. And the bond market at the long end, anything I can say about it, but the best thing you can say about TLT et al. Is that it's just is going sideways against one of the great domestic expansions, if you will.
Yeah, I don't see where you get the
so
domestic
it doesn't
expansion
feel like
from. That's the thing. It's, to me, the bond market is saying, look, one of the reasons why it's not a slam dunk case is you got to remember that we're talking about rates of change. The rates of change can be positive, but still be deflationary. If an economy needs 5% monetary growth in order to feed potential GDP, and it's only getting 3% monetary growth, the world doesn't look like it's ending. But yet there's a deflationary drag and dollar shortage there anyway. And that's, I think, the situation that we have. It's the growth rate of dollar expansion is much less, significantly less, but it's not negative. It's not crashing. And so that leads to all sorts of what seem like anecdotal, smaller cases where you have disruptions rather than, holy crap, it's 2008 again, and everybody knows this is deflation. I think there's gradation here, which, of course, leads to ambiguity and a whole bunch of other discussions. But I think the overwhelming sense of where the markets are outside of, say, equities is that the dollar shortage is a real thing and it's still happening and it's still substantial, which is why you have flat curves instead of steepening curves.
Yeah. So I mean, I would have dollar shortage, evidence of dollar shortage, impeccable. I think you cannot argue with the failure of the Chinese 10-year to exceed 2%, the failure of the US 10-year Treasury to exceed at 5%. Like, again, and if people are not familiar with this, it's a rule that I've observed, which is that this century, the number of weeks that we have actually traded with a 5-year handle on the 10-year is 6 weeks, if that.
Almost zero, yeah.
Right. And there is a 5% barrier. And as long as bond yields are below 5, and then the Chinese is below 2, I think you have to be cognizant of a dollar shortage. But then I think at that point, to get your dollar shortage, the manifestation and what becomes the delivery mechanism is that you need a bear market in the US stock market, because as long as
you're saying that's sort of like the final confirming unambiguous signal?
Well, yes. So it's never ambiguous, is it? But unambiguous.
I wish it was.
But no. So what I want to say is you can whack-a-mole with gold, right, to meet your margin, which is you coming back to your dollar shortage. There's a dollar shortage. I've got to sell a risk asset, okay. But again, we are inches away from this. I mean, we're bombing around again, and the S&P is like, I'm busy going higher, okay. And so yes, there might be one-off sell-offs and things like gold, but as long as this 80 trillion asset holds steady and is showing appreciation, you don't actually get the dollar shortage, but you bring 20% off the S&P, and the risk ripple and the risk assessment, or the change in risk assessment through counterparties in the private global banking system, you go from, I'm a risk taker, I'm risk seeking, to I don't know. And that's a huge change, and that's liquidity, and that requires counterparties to actually sell assets, sell risk assets.
Well, part of it too is just
it feeds on itself.
The order of function too. Is the stock market just is it the end at the end of the line or the beginning of the line? See, I would argue that it's at the end of the line. So you have tremendous dollar shortage and dollar pressure building in these small ways that seem ambiguous at first, and maybe even unimportant. And maybe the stock market ignores them forever, and then all of a sudden, just like in 2007, not making the comparison. The reason why the stock market hit a high in October 2007 was that it was at the end of the line, or closer to the end of the line than the beginning of the line. So where do you value the stock market as far as in the process of liquidity, assuming the stock markets really pay attention to liquidity to begin with? But that's why we have these discussions. That's why we go to St. Bart's to your house to have these discussions, because if it was ambiguous, you wouldn't need me. it would be easy just to say, oh, this is what's happening. If we had, the old quantitative measures of M1, M2, or M3, or what any of the M's, we could just say, hey, this is what dollar liquidity looks like. I wish it was unambiguous, but unfortunately it's not.